We heard flying is one of the safest ways for traveling. I think our next speaker, Pius Fritschi, had a very long flight from his office to Sedan Plaza. He's a managing partner at LGT Capital Partners. Before that, he was senior partner at McKinsey & Company. Thank you for coming to Sedan Plaza. Thank you.
Ladies and gentlemen, it's a pleasure to me to be able to speak to you, especially as you all probably are waiting more for lunchtime than now listening to my speech, but I will try actually to do my best. So, to start, this morning we had a discussion about asset management finance plays Switzerland, and we heard some ideas what it needs to become a successful asset management place. What I would like to do is give you some insights maybe about our history and how we think about it. Basically, I believe there are like two elements which make an asset management financing place successful. One is actually about performance. So Andreas Schlatter mentioned that this morning. Performance is at the end key. I think it's quite different maybe from the private banking world. If you don't have successful performance, you will not succeed in the long term. And second, it's probably about innovation. And that's maybe the title of my presentation today. Let's talk about maybe alternative thinking. Use open-minded approaches, because if you go with the mainstream, you will not succeed. There is a very, very competitive market outside, and maybe what I would like to do is now give you some insights on innovation as well. To start with, who are we? Capital Partners, 50 billion, 300 staff, 400 clients. Main office is here in Pfäffikon, just the site, has been mentioned. I think we are the largest employer here in this region, and strong focus on the alternative markets, private equity, the biggest part, and then it's hedge funds, ILS, as other elements. Now, this morning, the moderator talked about the restaurants and the analogy about it. And so I thought more, if I would describe ourselves as a restaurant, what would that be? And it's for sure not an Italian restaurant, which is mainstream, I think everybody goes to. So still, given our size, but still, I would probably call us more like a Lebanese restaurant, or maybe at the most, it's a Japanese restaurant. It's something most people somehow know about, that it exists. I think there's like very few Lebanese restaurants in Zurich. Very few people actually went there, but there's a lot of people who know about it, and a lot of people probably have an opinion about it. I assume most people never went there and never tasted the food, because I think most people who went there, I think it's food is actually quite great. And somehow it's still similar with the alternative industry. You know? There's all opinions around what that is. Urs mentioned it beforehand. There is what is public equity versus private equity, this illiquidity thing. What I try to do is explain you in our story that actually this is not so alternative. If you have a more open-minded mindset, then actually it's not so alternative and so wild as it sounds. So let me try. First, some insights from our endowment story. If you look at the market in the last 5 to 6 years, of course, we see now US equities all-time high, and we see the bond market at all-time low. So in the last 5 years, the best performing portfolio was actually a 50-50 portfolio between bond and equities. So you didn't need any alternatives. You didn't need any liquidity, no exotic stuff, 50% portfolio in bonds, 50% in equity, and you did extremely well. Now, question to all of you. How many of you believe that this is the right asset allocation for the next 5 years? So how good is the chance that the 50-50 portfolio, looking at that picture, is probably the right one for the future? Now, the answer is we don't know. We actually don't know. But most likely, looking backwards won't help you too much. So our approach always has been, in the last 15 years, a very different one. We don't know about the future. So we believe more in scenario thinking, forward-looking thinking, and we believe as well in diversification. We manage the money of the Princely portfolio. That was the original idea of the company at that time, starting 15 years ago or 17 years ago with 1 billion. Today, the fund, just the endowment fund, is 10 billion plus. What we always did from the very beginning, we have a very high allocation to alternatives. So 50% plus is alternatives. It consists of all kinds of hedge fund strategies, other exotic strategies. 25% is private equity with, and the rest is all diversified across the different long-only strategies. Now, this has performed quite well, actually. It's close to tripled over the last 15 years through 2 financial crises. And that's why we strongly believe, especially where we are today, that diversification actually helps. Now, diversification is not only about asset classes. So that's one thing I really want to make a strong point out of it. If we think about this, our endowment structure and the way we manage it, we think much more about risk factors than just asset classes. So you don't have to look into details in here, and there's a lot of models behind doing that. But at the end, it's much more than just thinking maybe about equity risk in the classical thing listed or the interest rate risks. And the more colors actually you have on that part, the better structured is your portfolio. That's a little bit the key conclusion, because then you have a bigger diversification element. And now, let me give you 3 examples just out of our context. First of all, equity risk premia, the way we look at it. At the end of the day, we invest in listed equity, we invest into long-short equity, and we invest into private equity, all 3 kind of. And what you can see actually on the chart from the performance, so the light gray one is the performance on the MSCI World, which was plus 29% over that whole period. We did actually, as a manager, we did quite well along all the 3 categories. But most important, we had good performance in listed, long, short, and private equity. So the point I want to make here is much more, in today's market where you're at the all-time high, probably adding long-short strategies to your long-only allocation or going into the private market at that moment in time makes perfect sense. So at least think about a mix. If you want to reduce volatility, if you want to still be invested in the equity risk premium as a risk factor, probably think about the way you allocate, and don't be single-minded that traditional listed equity is something better than the rest. Actually, we talk about equity, and I think Urs also made that point before. Another example. One element more, just highlighting Urs' point, so let me be short on that one. But at the end of the day, we also believe that if you look at the way private equity companies are managed, they are better managed than listed companies, and there are many, many examples. And for sure, as you see here, governance is a key important point. The focus on value creation is very, very different. So the boards on listed companies, and I have some experience actually talking about that one from my past life, is quite different to what we see what the private equity firm does today. Second example, credit risk premium. Similar. You can actually invest publicly on the bond side, be it now high yields or loans, or you can invest on the private debt side, which of course is illiquid, and then you talk about all the type of risks. But fact is, again, if you look at today's market, so the spreads for investing, for example, in US high yield is extremely low. So I think we have been seeing that we went up the curve over the last 5 years, and there is probably not so much room or space left over. So you have to think hard if you're still well compensated for the risk you take if you invest actually at that point in time. Now, if you look on the illiquid side, the private debt side, the picture I think is quite different. There you see opportunities which most investors are not capturing today. One example of that one, a very opportunistic example, but if you look at the European banking market, it's actually quite dislocated. So there's a lot of stress, of course, driven by now the discussion of Basel III, all these regulations in place, but at the end, the main goal of a bank CEO today probably is managing the bank balance sheet and making sure that the analysts believe that he's well capitalized. That's actually the key driver of it. This gives a lot of opportunity right now in the market. So what we do is we buy, for example, loan portfolios out of bank balance sheets, And this is highly interesting because on one hand you see the mature portfolio, so you can look deeply into it. It has been rated, for example, it has been gone through the financial crisis in 2008, so it's maybe a mature portfolio. And in addition, you get it to a significant discount because the seller is distressed. Not actually the underlying portfolio, but the seller. He has to get actually rid of it to capture and to generate capital. So just one idea maybe how you should look at credit as a risk premia and also look at opportunities beyond the obvious. Another example is ILS. We also had a presentation from 12 already. So ILS, we are like invested since 10 years. We look at it as an event risk premia. And of course, one of the attractiveness investing into natural catastrophic risk is it's decorrelated. So we would call out of all investments, we could call ILS the most decorrelated strategy we have. And investing in such a category, adding that to the portfolio, I think it makes a lot of sense. And that's the experience. And if you look at more detailed, somehow the investments performance over the last 10 years, it has worked out quite well. Nevertheless, that you had some natural catastrophic events, and maybe even in the future we'll see more of them. You have to look at the risk premiums are still the right one, but at the end of the day, adding it to the portfolio compared to purely equities, corporate bonds, I think it makes a lot of sense. Now, having mentioned that, I also want to give you some thoughts from the work we do with a lot of institutional clients worldwide, just about innovation or how we see global investors acting. And Urs also mentioned one already on the private equity side, the Canadian investors. I think they are very sophisticated. It's a very different way to look at it to what maybe I see today happening in the Swiss market. So here are some also as well 3 examples. The first one, it's one of the largest Swedish public pension plan. What they did actually, in contrary to a lot of other investors, they thought carefully about the composition of their portfolio and made the conclusion that they need to diversify away the equity risk of their long-only side. So they made a point that they say we'll allocate 1.5 billion into hedge funds. And then they actually had the studies for like 18 months going through how they would do it. They started with a portfolio that invests in all different type of styles. At the end, through the whole process, they did something quite different. What they did at the end, they invested the whole part. It's now invested purely in CTA managed futures. Now, some of you would say like it hasn't worked, it hasn't performed very well in the last 2-3 years. Actually, that's not their concern at all if you talk to them. They are very happy about it, because at the end of the day, as you can see in the chart, it has a specific role in the portfolio. It has to protect in downside market when equity is really falling into drawdowns. That's when it has to work out. And if you look clearly month by month, that still has worked so far. So they look at it as a protection, and a better protection than if you would hedge it, because it also generates some returns over the long term. Just one example how to look at a specific point. Another example from Canada is they already have a very large hedge funds portfolio, which is split across the 4 different styles. Now, today what they do, they also think about costs. They also believe, actually, I don't have to pay 220 for everything, for all of these underlyings. So, but what they start to do is they say, like, I still need hedge fund exposures. So the answer is not, I completely move out of hedge funds, it's too expensive, I can't afford, and I'm back into whatever the long-only world. So what they do is, actually, they study how can they, through style premia, how can they get exposure in a more cost-efficient way, and then adding the managers which are really somehow producing the type of alpha or manager skill that they're looking for, and they're happy to pay for that part. But in total, I think the portfolio will be more efficient than we have seen in the past. And the last example from the UK, it's a local authority pension fund. What they did is actually, and that's maybe the Anglo-Saxon world, they always have been more exposed to the equity market. What they see is that in today's portfolio construction, they are heavily exposed to the equity market. And they realized that on one hand, they need that type of return, and they won't get it, of course, from the bond market, so it's not an option to shift more to the bond market. But they realized they need it in a more diversified or more robust way, in the way the portfolio is constructed. So what they did is actually they went out and searched for a provider who is able actually to create a whole multi-alternative portfolio which gives them access to all these type of strategies. And that's then this combination, and you see it can be actually from the long side, emerging markets or convertibles, but then a big part goes into the hedge funds and the illiquid part also into the private markets element. And that's where they allocated 10% of the portfolio in today, and that might be even growing. So it's just an example also how they come from the portfolio construction view and from a strong investor perspective, thinking about where the market today is and what they should do so therefore in the future, and trying to be proactive and not actually reacting after something has happened in the maybe listed market. With that, I already want to somehow close my presentations and just give you 3 reflections on the Swiss market. The first one, I believe we need, as a financing place, we need a forward-looking approach. And you also don't drive around with the back mirror. So having all that work being done currently, thinking through how the performance, the indexes and everything worked out over the last years, I'm not sure if that helps too much. In the way we manage the business, it doesn't help. What helps a lot is thinking in scenarios. So forward-looking scenarios, what's the best, maybe the best construction you can have, in which type of scenarios maybe you believe stronger, and therefore how would you even construct a portfolio around it, and therefore would you add different strategies and maybe it gets to a customized solution at the end of the day, but thinking about that broader than just in the traditional sense. The second point is this discussion even about alternatives, and at the maximum we should invest that much into alternatives, and it's anyway a cost-expensive way to do it. I think it's just completely the wrong discussion. At the end of the day, what we need to do, every investor, every institutional investor, every private investor has to figure out what type of strategies he needs and what's the best portfolio construction, therefore, at the end of the day. And therefore, as we had the example, adding private equity, for example, to the portfolio where the market is today, I think makes a lot of sense. So it's not a discussion. And today, if you look at the incentives of manager on the institutional side in Switzerland, know that you have to publish TERs. I think many of them, what they do today is they are benchmarked along the cost, the TER ratio. But if you have that as a benchmark, I mean, the result of it is, for example, you would not invest into private equity. Because you can't. I mean, it's just worsening your TER. And if that's the discussion, I think we do exactly, at the given point in time, we do exactly the wrong thing, what you would do from an investor perspective. So we need to be sure that we still have an investor perspective, and at the end of the day, we also need to look at the overall. And the final point I want to make is where markets are today, we have a strong belief that illiquidity actually helps. So we see more opportunities from an investment side in that part, be it in private debt, be it the ILS space on the illiquid side, be it the private equity one. And therefore, I think we should be careful in not talking only about cost, but look at net returns. Maybe it's risk-adjusted net returns, but I think that's the more relevant measure than just, for example, TR. Let me thank you very much for your attention, and maybe there are 1 or 2 questions.
Yeah, okay. Thank you very much, Mr. Fritschi. Also, in order to stay on schedule, just 1 question. We can already start with the rebuilding process over there. Is there a question you'd like to direct to Mr. Fritschi? Otherwise, you will stay on stage. You can just stay with us. You will get your present later on. There's another task to be fulfilled. We're moving on with our panel discussion. You already know all the panelists, but you do not yet know the moderator of the panel discussion. That's Dr. Monika Machler. She is a member of the supervisory board of Deutsche Börse and